Since 2021, inflation in the US is up about 16%. Your home insurance is up about 46%. That is nearly 3 times faster, and it is now baked into your monthly payment for good. If you are a homeowner between 35 and 55 who keeps watching that mortgage statement creep up and cannot figure out why, this is not your insurer singling you out. It is a national repricing that landed on your escrow account while you were busy paying the rest of your bills. Most people think they understand their mortgage payment, principal, interest, taxes, insurance. 4 boxes. 3 of those boxes are relatively predictable. One of them has been running wild for 4 years straight. And the sneaky part is that it moves through a mechanism most homeowners never look at twice. The math behind it is worse than most renewal notices will ever tell you. There is a line in your escrow account I want you to find. Not the principal line, not the interest line. The homeowner's insurance line. Most people glance at that number once a year when their lender sends the annual escrow analysis, then file it away. What I call the silent line. It sits there quietly, adjusts automatically, and adds to your payment with almost no friction and almost no visibility. The lender pays your insured directly. You never write a check. You never feel the sting. You just notice 6 months later that your payment is somehow $75 higher than it was last spring. And you assume it was taxes. It was not taxes. It was the silent line. If this kind of breakdown is useful to you, the Compound Classroom is where we do this every week. Hit subscribe and we will keep running the numbers together. Now let me show you what the silent line has actually been doing since 2021. Because the data here is not subtle. Let me put 2 bars in front of you. Imagine them side by side, same starting point, January 2021. The left bar is general inflation. Everything you buy. Groceries, gas, rent, services. By the end of 2025, that bar has grown 16%. That is real. That is painful. 16% on everything stings. Now look at the right bar. That is your homeowner's insurance premium. By the end of 2025, that bar has grown 46%, nearly 3 times taller than the bar on the left. Same 4-year window, same American economy, but the right bar belongs to a line item that moves through your escrow without a single phone call, without a single conversation with your lender, and without any action required from you. It just grows, silently. Insurify pulled data from across the insurance market and published this in March 2026. Since 2021, the average homeowner is now paying $900 more per year than they were 4 years ago. The national average premium hit $2,948 by the end of 2025, and 95% of zip codes in the country saw increases, according to the Consumer Federation of America. This is not a coastal thing. It is not a Florida thing. It is not a bad neighborhood thing. 1/3 of all zip codes in the country saw their premiums rise by more than 30%. The silent line is a national phenomenon. Andre opened his escrow analysis letter in February. He had been in the same house for 4 years, same mortgage, same coverage amount, no claims filed. His monthly payment had gone $41 from the previous year. He assumed it was property taxes. He set the letter aside. It was not taxes. His annual premium had climbed from $2,100 to $2,600 over 3 years. Nearly $500 more per year. It happened in small increments, each one feeling manageable, each one absorbed by the escrow system without a bill, without a phone call, without a conversation. The silent line had been moving for 3 years and he had not noticed once. That is how the mechanism works. Not maliciously, just automatically, and automatic tends to go unexamined. Now let me put a number on the silence. From 2021 to 2021, the average annual premium went from roughly $2,000 to nearly $2,948. That is an increase of roughly $948 per year. Divide by 12, and the silent line grew by about $79 per month inside your escrow. $79 a month does not sound catastrophic, but $79 per month compounding year over year for 4 years while your mortgage principal barely moves and your interest rate is locked means the most volatile component of your housing cost is the one you never negotiated, never approved, and never saw as a line item on your monthly statement. It was just absorbed automatically. And here's the detail that makes this more uncomfortable. Because insurance is paid annually out of escrow rather than monthly out of your checking account, most homeowners experience the increase as a smooth and visible adjustment rather than a lump sum bill. If your insurer sent you a check for $948 on January 1st with the words premium increase enclosed, you would feel it immediately. You might call, you might shop. Instead, the $79 monthly adjustment happens in the background. The lender does the math. Your payment goes up by an amount that feels almost reasonable. The mechanism of escrow, designed for convenience, also functions as an anesthetic. You do not feel the full weight of the needle. Now here is the objection I hear most often at this point. The market is slowing down. 2025 was better than 2024. And that is true. In 2024, the national average jumped 18% in a single year. In 2025, it cooled to 12%. That sounds like progress. But compound growth does not care that the pace slowed down. The 46% accumulation since 2021 is already locked into your escrow baseline. Your lender recalibrated your payment based on the new premium. That recalibration does not reverse when growth slows. The slower year means the bar grows a little less quickly. It does not shrink. You are not getting a refund. Think of it this way. If someone had been quietly adding weight to your backpack every year for 4 years and then said, "Good news, I am only adding a little this year," you would not celebrate. You would point at the backpack. So why did this happen? This is where most articles stop at climate change and move on, and climate is part of it. Severe convective storms alone caused over $52 billion in insured losses in 2025. But the mechanism that transmitted those losses directly into your escrow is something most homeowners have never heard of. It is what I call reinsurance repricing. Here is how it works. Your insurer, the company whose name is on your policy, does not actually absorb all the risk of your house. They offload a portion of that risk to a separate tier of companies called reinsurers. Think of it as insurance for insurance companies. When a hurricane wipes out 1,000 homes, your insurer files claims against its reinsurer to help cover the losses. For most of the 2010s, the system was relatively stable and priced conservatively. Then, starting around 2022, following a sequence of record catastrophe years, reinsurers dramatically raised their prices. They told primary insurers the risk has changed, our rates are going up. And primary insurers, who cannot absorb that cost spike without going insolvent, passed it directly down the chain to your policy, to the silent line. In 2023, insurers were paying out $1.11 in claims for every dollar they collected in premiums. They were losing money on homeowners insurance. That math forces a correction. And the correction lands on your escrow statement, one adjusted payment at a time. This is the part that matters most for how you think about the problem. You did not do anything to trigger reinsurance repricing. You did not file a claim. You did not move to a flood zone. You did not change your coverage. A pricing decision made at the wholesale level of global risk capital landed on your monthly payment. That is the villain in this story, not your choices in the architecture. Now I want to show you the second order effect. and one that most homeowners do not see until it has already happened to them. Insurance now represents roughly 9% of the typical American homeowner's monthly mortgage payment. That is an all-time high. From 2013 to 2020, that share was under 7%. The ICE Mortgage Monitor reported this explicitly in late 2024. In some cities, it is more extreme. In parts of Oklahoma City, Wichita, and Tulsa, insurance alone accounts for more than 50% of the monthly payment. This is no longer a rounding error on your housing cost. It is a structural component quietly reshaping what homeownership actually costs at the monthly level. And here is the downstream consequence. Higher premiums push borrowers' debt-to-income ratios up. Some buyers who would have qualified for a mortgage 2 years ago no longer qualify today. Not because their income dropped, not because their credit slipped, because insurance costs raise the total payment past the lender's threshold. And this is what Matic flagged at the end of 2025. Insurance is playing a much bigger role in housing outcomes than it did even a few years ago. The silent line is no longer just a personal finance problem. It is starting to reshape who can buy a home. Let me translate this into something more personal. $900 more per year. If your household takes home around $60,000 annually, that is roughly 6 days of your working year. 6 days you got up, commuted, delivered results, and the entire output went toward keeping your insurance premium at the 2025 level. Not buying more coverage, not building equity, just standing still against the repriced market. Every year, the baseline rises. You work a few more days just to stay in place. That is the arithmetic of the silent line. Now let's talk about what you can actually do. Because the protocol here is not complicated, it is just specific. Step 1 is to pull your last 3 renewal notices and write down your annual premium for each year. Most people have these in their email archive or in the annual escrow analysis letter from their lender. You're looking for one thing: your personal rate of increase, not the national average. You're lying. If your premium went from $1,800 in 2021 to $2,600 today, that is a 44% increase on your specific property. Now compare that to your income growth over the same period. If your wages grew 12%, but your premium grew 44%, the silent line has been outpacing your raise for 3 years running. You need to see that comparison on paper before you can make a rational decision about what to do next. Most people never make this comparison. They feel vaguely that things cost more, but they cannot name the exact gap. Naming the gap is the first move. Step 2 is to calculate what percentage of your total monthly payment now goes to insurance. Take your annual premium, divide by 12, and divide that result by your total monthly mortgage payment. If that number is above 9%, you are at the national all-time high. If it is above 12%, you are in the zone where insurance is materially compressing your cash flow in ways that compound over time. Step 3 is to shop the policy actively before your next renewal and to have a deliberate conversation about your deductible. This is a step most homeowners skip because switching insurance feels like friction. The data says the friction is worth it. Homeowners who switched carriers in 2025 saved an average of $928 per year, according to Matic. It is nearly the entire dollar amount the silent line added since 2021, recovered in one focused afternoon. While you are shopping, consider raising your deductible intentionally. Moving from $1,000 deductible to $2,500 can cut your annual premium by 15 to 22%. That is not a desperate move, it is a deliberate trade. You are choosing to self-insure a larger slice of small claims in exchange for a lower structural cost. For homeowners with solid emergency savings, this math often works. but you need to run it against your specific numbers, not assume the average applies to your situation. 2 additional notes before you start shopping. Bundle discounts for combining home and auto with the same carrier average around $287 per year. And loyalty does not consistently reward you in this market. Carriers reprice actively based on their own risk models and their exposure to regional catastrophe losses. The cheapest carrier from 3 years ago may not be cheapest today. Annual shopping is no longer optional. It is the correct default behavior in a repriced market. The honest framing on what comes next. Reinsurers repricing is structural, not temporary. Climate losses are not reversing. Projections from Insurify suggest a further 4% increase nationally in 2026. That is slower than prior years, but the baseline is dramatically higher now. Even modest percentage increases on a 2,948 generate larger absolute dollar amounts than double-digit increases did on a $2,000 average in 2019. You cannot change the architecture, but you can refuse to passively overpay within it. The side of the line gets louder every year you do not look at it. Looking at it, comparing it, and shopping it actively once a year are the 3 moves that put you back in control of a cost that was designed to move without your attention. Tell me in the comments, when did you last actually track your homeowner's insurance premium year over year? Not just accept the escrow adjustment, but pull the numbers, compare them to your income growth, and decide deliberately. I want to know how many of you have been watching this line move and how many are seeing it clearly for the first time today. And if you are a homeowner between 35 and 55 trying to get a real hand on your housing costs, hit subscribe. We publish one of these every week. I'm Andre, and I will see you in the next one.